Good morning, ladies and gentlemen. Well, the model is at 69, so it actually closed the week better than it started the week. The model works on spreads, not on price. So what does it mean that the model closed higher? It means that risky spreads actually outperformed defensive assets on a spread basis. And that is quite interesting at this stage. It, to me, suggests that we are about to turn higher in asset prices, but we shall see. The bonds are very much teetering on the edge, and let's have a look at what the model scores are predicting in terms of ranges and volatility. If we go to spread ratios, you will see that these dispersions are becoming greater. But the thing that interests me is that technology is still in the 17% percentile of volatility. And that tells me that unless technology picks up in vol, assets are just absolutely fine. They will not drop very much, and that defensives will be underperforming the technology sector. And if that is the case, I just can't see how asset prices can dump. If now we go to model score research, by these volatility predictors of 1 day and 5 day. So for next week, we're looking for a mean of 0.3 up or down in terms of asset price variation. So still very, very small. The model is saying we are not in a phase where equity prices can move very aggressively. And therefore, I think that next week will be hopefully a quieter week with asset prices doing slightly better. But the thing that is always possible here, because of the way the model is set up, is that we start getting bigger variances. But that is for the future. I think next week the equities will trade in a relatively narrow upside range. That is what the model is saying. And that tells me that if that happens, bonds are not going to be as volatile as they were last week. But let's have a look at the bonds, because they are just teetering on the edge. And the model is predicting that they do not go over the edge, at least not next week. What did the yield curve do last week? Well, it basically pivoted around the 3s and 5s, with the longer end, 10s and 30s, 10s to 30s rather, going up, while the 2s had a very quiet week, and the 3s and 5s had a non-existent week. I think that had a lot to do with fears of a government shutdown, which now we know has been postponed, at the very least, if we are even going to have one. So I think the yield curve will behave the opposite way next week. I think any pressure is going to be in the 2s, 3s and 5s rather than in the longer end, simply unwinding the parking of money that was evident in this part of the curve, where people feared what would happen to the yield curve and to asset prices in general in case there was a government shutdown, which now we know has been averted. In which case, it is logical to expect that this basically unwinds and that any pressure is at the front part of the curve rather than the long end. Real yields continue upwards. This is a chart going all the way back up to 2003, and you can see we are basically at the highs that we've been for the past several decades. If you disregard this period in 2009, which was basically a deflationary period. Yield rather on tens was anywhere positive, the real yield would have been incredibly high. So for any other normal period like this period, we are basically as high as we have been. And that is why I just don't think that we can keep on going to ever higher real yields without triggering an accident at some stage. I think 227 in real yield seems to be quite attractive to me, and actually the price of gold is suggesting that yes, it is attractive. If we look at term premium, that is still quite low. Can it go up another 20-30 basis points? Absolutely. But I just don't think that is that is as likely as people think. If we go all the way back to the 1990s, term premium was never really higher than 1%, but then we had positive yield curves. And yes, can I see it up to these levels of around 0.5? Yes, I can, but that is only like 40 basis points away from here. And the implications of it getting there would be that we never, ever again expect the Fed to cut rates, which to me is unlikely. I just don't see the curve disinverting yet. But term premium can definitely put some more pressure on bonds, and that is what worries me. I think that we are at very, very important levels, and that we start going through here, nothing good is going to come of it. If we look at what the yield curve did last week, well, it's obvious. Bear steepening on steroids. 2s 10s and 2s 30s, they're right now getting towards support. And I think it makes sense after the avoidance of this government shutdown that these relationships start normalizing back over the course of the next week or so, back up to around at least 58, 59. So that's 10 basis points of flattening. It just very difficult for me to see the bonds going through the levels that they're at. Because let's have a look at the 30s, and I think that is key, and that will actually tell you which way the yield curve is going and everything. And let's take it back to even a monthly chart. Okay, these are the levels that I've been expecting to top it for quite some time. Basically, anywhere between 472 and 484. That is as high as we have been since 2008. And if we go even back, those were the lows back in 1998 and then in 2001. If we start going through here, there's very, very little till about this level, which is 5, let's call it 5.25. So that is yet another good 50 basis points of move in the 30-year. It would take it through all the Bollinger Bands, monthly, weekly, daily, you name it. And it's another 10%. That would have to have a major impact on just about everything in the world. That's why I just can't see it happening now, because as I showed you, we have a positive term premium. We have real rates in the 2s. Can another 50 basis points happen? Yes, at any stage. And that is, well, my position, and that I'm worried about it, and what I can lose, and that's why I did an option as opposed to an outright, because I recognize that there is a serious possibility that this happens. I just think that it's unwarranted. Do we need long-term rates up another 50 basis points? Well, the only reason why that would happen is because we have so much supply. And we have another QRA coming in November, early November, and they could decide to issue a shitload more bonds, in which case that will probably happen. I just think it's too early for it to happen right now. With the information that we have, we know that the economy is doing fine. We know that inflation is also on a descending glide path, and therefore, even if bonds stayed at this level, you would still have higher real rates because inflation, core PCE, is coming down, and therefore bonds, just by staying here, are giving you real, over time, higher real rates. That's why I think it's so unlikely that it happens right now. But we do have a lot of data next week, and we shall find out if, my theory is correct. Going back to a one day, at least we did close below this 472 level. And given the fact that we don't have the government shutdown, I expect us to probably retest these levels next week, but hold, and do not very much at all on the week unless the data is very, very strong. If we get a normal week with data which is not particularly strong, I would expect you to trade between here, this 458, 459, 460 level, and 478, 480. That I expect it to do some sort of a flagging in that area. But now we know we're going to get NFP. We know we're going to get all the other important data like the ISMs and the JOLTS and so on. So it's entirely data dependent what we do next week. But I've shown you where real yields are, and you tell me if those are attractive enough to stop it for a bit. So as I showed you, while the action last week was very much in the 10s and 30s, I think this week is going to be very much in the 2s and 5s. If the data is strong, I don't think that 5s hold these levels. They go all the way up to 486, which is new highs, and the 2s, I think, get to 527. But we should be getting a little bit of a flattening curve, and that is the other reason why I don't see the 30s and the 10s getting absolutely killed. So that is the way I see it. I think that any kind of strength from the data is going to spike the 2s to 5s area. We're going to take out even more predictions or possibilities of cuts in 2024 and 2025, and then we're going to start pricing in a hike at the FOMC meeting on the 1st of November. I think that's clear. To me, the odds are that the longer end next week does not a lot, and that the short end, if the data is strong, goes up. What really worries me is this monthly chart of the Buxel, so the 30-year in Germany, going to about here, isn't it? I mean, it has the room, and so you're looking about 350 odd. Whether it's 350 exactly or 352, 353, who cares? It has the room to do it. This is a monthly chart, of course, and if we take it to one day, this formation tells me that even if you get a little bit of a pause here, it will reaccelerate at some point. And the yield curve has been doing exactly the same as in the States, i.e. it has been steepening, bear steepening, and it's at very, very important levels. So next week is going to be very important for the European rates as well. As you can see, the 2s, the SHATs, and the 5s are really not doing very much. But I would expect them to start moving as well if the long end is looking sick. So here we have the Bund. It did not close the week above that 290 area, but if we go to a monthly chart of that, you can see how much more room it has. It's saying I'm going all the way to 365. So next week I think is going to be very important whether we manage to stay below these levels or we actually bust through them. Because if we start busting through them in the EU, in Germany, I just can't see how we don't bust through them in the US, simply because the supply is in the US. And what bad news are we going to get in Europe, which is so much more damaging to Europe than it is to the US? I mean, we all know that the economy in Europe is far weaker than in the US. We know that inflation should be coming down just as fast. So really it's puzzling, because if Europe starts going through these levels, I mean, you can bet that the US has to follow. So this is now 30s, US against Germany. And the implication of Germany going up and the US not is that we go and retest these 147 levels. But I just can't see us staying there, and I can't see us busting through that. As I said earlier, the supply is all in the US. All the bad news about the economy being stronger than expected or whatever is in the US. I just can't see this market coming down and staying down. I think it's as simple as that. And if we look at tens, every time it comes back below the 173 towards the low 160s, it gets bought up again, because it makes sense that that should happen. And that is what really worries me about the chart of the individual Buxel and Bund, is that they have a lot more room to move up, and I just can't see how these spreads against the US are going to come down and stay down. I mean, can we have a bad day and come down towards 150, 155? Yeah, we can. But I think the world is going to want to buy them there on a spread. And that is why I just can't see that happening next week. But we shall see. The data is going to guide us. And as I said earlier, strong data, sell 2s and 5s, weak data. I guess that we've got enough term premium for the time being, and we've got enough high enough real rates rather for the bond market to take a breather. That is my favored way, but that means nothing. A word about Bund BTP. To me, this is still bullish. Closed the week well above 188. I reckon this level is broken. We have to go and test the high of the year, basically around this 203 area. And then I think my target is 216. So any dip down to here, I will be a buyer. Looking for 203 first and then 216. I think it's the same argument as the Bund against the US. On any dip, Germany is going to issue less and Italy is going to issue more, just like the US. And if we look at the butterfly, whereby the bunds are in the middle and the US and Italy are on the wings, any kind of move to this kind of level, you are looking, basically to buy the Bund, sell the BTPs, sell the US for a move down to 406. And that is what I'm looking for and what I want to add to. If you have the UK as in the middle, I think it's coming to very attractive levels around 90 to 100, whereby you sell the UK and you buy the US and you buy Germany, eventually to move back out to here, because the The Bank of England has the loosest policy of all in real terms. So I don't think that gilts can really outperform the EU or the US in the long term. So these are two spreads which to me make sense for the very long term. Well, you know what I'm going to say about the Dixie, so there's no point in me laboring it. I personally think that we are now running on air, having gone up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks in a row. And we are just following the upper Bollinger Band on the weeklies, aren't we? But, you know, the risk reward of being long up here, with the spreads having done so much, you know, the 10s to 173 that we're not busting through yet and so on, to me it just means that we are vulnerable to any kind of bad news in the US actually bringing us down towards the 104s, 105s. Do I buy it, in the 104s? Yes, I do, because I think that will continue at some stage. But to buy it right up here, unless you get amazingly strong numbers, is probably, bad risk reward. That's all. I'm not saying it doesn't go up anymore. I'm just saying at these levels, what are you going to make? So I would prefer, and I think it would be healthier longer term, to see a move back down into the 104s. The market can recharge and go again. But naturally, the market doesn't want to make it easy for you. So it probably won't. But all I'm saying, up here, I think the risk reward is not great. Well, gold is finally going the way I thought it should do all the time. Where is support? 1820, 1830. I've got the line here at 1830. And if that fails, then it's going to 1764. And we all remember 1764. But, okay, so why should gold go down? Well, gold should go down because real yields are above 2%. So why would you hold gold as anything but a diversifier against your portfolio, which is the right thing to do, don't get me wrong. But why would you pay 1950 for it? It just seems unrealistic to me for the time being. I think that it's far more likely to come down and bounce from these levels, 1725, than it is, and then bounce to where, 1900, and that's about it. I just think that it's very, very unlikely that this is a major buying opportunity. It might be a major buying opportunity for $25, but that's about it. So to me, 1825, 1830 is the target, and then a bounce to 1900. That makes sense from a macro point of view, a fundamental point of view, the way I see assets moving, and now I'll show you why. So this is a chart of GLD over TLT. And if we have a look at where we started the year, we started about 170, let's call it between friends, and then now we went up to nearly 200. Okay, so that is a big move in percentage terms. And I think that this is likely to be unwound a bit, and we are likely to continue trading around here, which basically would mean that gold does a couple of percent worse than bonds. That is sensible to me simply because of the real yield that you are getting now on bonds. Throughout this period here from the beginning of the year, you had a negative term premium and you had a less than positive, significantly positive, let's call it, real yield. Now you have probably the highest real yields you've seen in 2 decades, just about. And why hold gold as a diversifier at the moment? You're giving up over time over the course of a GLD TLT lifetime a huge amount to have the diversification. Let's go back to GLD TLT, and you see from 2020, it's doubled. Does that make sense? It makes sense that it should be higher, but double, I find that difficult to believe. So on a diversifier basis, it's losing its appeal simply because real interest rates are as high as they are. And I think that GLD should trade down even against TLT, and TLT doesn't show many signs of life, does it? I mean, and even DBC is not showing a lot here. I think that my view is that gold and assets in inflation-proof assets like commodities are really beginning to feel the over 2% real rates. And I don't think they can accelerate because I don't think the economy is likely to accelerate. And if we go over to a chart of oil, it had to take out, a few stops above here, but it closed the week not up. And I think it's far more likely to oscillate in this range than it is to accelerate upwards. I just don't see what is going to make it accelerate upwards apart from a very, very strong economy. And anytime you get 2% real yields, you can have a very nice economy, but an accelerating one with accelerating inflation, I just can't really see it. I might be wrong, but I just would not buy oil up here. And if I wouldn't buy oil up here, I can't buy DBC up here. And if I can't really buy DBC, then why on earth would I buy gold? So it all goes into a circular argument, and it's just not for me. I think I would rather buy TLT with a 2% real yield and ride it for a while and trade against it. Are equities rich against bonds? Yeah, okay, they are. But we've just closed the third quarter. We know what happened during Q3. Did anything bad happen? Not really. Are earnings likely to disappoint? No, not really. Are they likely to surprise to the upside? Not particularly. So we are in a period of sideways. Unless we start getting some data which says that the economy is accelerating upwards and bond yields start breaking those levels that I gave you, in which case the stock market will come down to more sensible, let's call it a times 17, right? So unless the bond market breaks things, equities aren't going to break by themselves. That's what I'm saying. It's in a trading range at the moment. The only thing that can break them for the next quarter are bonds. If they start going 30, 40, 50 basis points higher, as I showed you, if you start breaking this level, you're going to 5.25. 5.25 breaks things because assuming that inflation hasn't accelerated, then you have real yields another 50 basis points higher. And not only are you likely to get real yields 50 basis points higher, but that's going to squeeze inflation even more. So you might get 3% real yields. And that is going to kill things. So until and unless we see that, I think we sort of go up, down, and that's it. Let's start off from a clean chart. And that basically tells you the story of the week. It touched the 42.55 level, closed above it, rallied, and then came down a little bit on Friday because everybody was afraid of a government shutdown. which, is nothing, and it's more theatre than anything else. We'll open higher and go higher, and then we'll come back down and close that gap. Because if it's theatre to the downside, a government shutdown, it's theatre to the upside as well. But it removes a little bit of uncertainty, and a few people need to be squeezed, etc., etc. So would I be surprised to see 43.85 next week? Absolutely not. Close this gap, and thank you very much. But I just can't see that this is a formation which portends a dump of significant proportions. To me, it's a nothing burger. So my favorite 195-minute chart still has the 200 period moving average going up. The 50 is coming down, but there's absolutely nothing to stop it from going and testing 43.90s, closing the gap. Absolutely nothing. Again, I just don't see this as anything but a normal retracement. And from there, if bonds start breaking higher, then yes, there will be a reason to come down to 41.64, close this gap into 4100, and panic into year end at, 3800. But the bonds have got to do it. I just don't see the economy rolling over and earnings rolling over and employment rolling over until and unless bonds really break things. And long bonds in the 5.25s, 5.5s is going to break a lot of stuff. So, and I don't expect that. Okay, so how can I expect this to happen to equities? I just can't see it. I refuse to believe that equities are going to dump a major amount. But if bonds start breaking things to the upside, then I will happily follow and be short of equities. But until then, no, I just won't do it. And if the most interest sensitive high beta index is not dumping like the NASDAQ, then why should I be worried about the S&Ps? I mean, it's just a sort of a bit of a circular argument, I know. But until I start seeing volatility in the NASDAQ, I can't really be that concerned about the S&Ps, and I won't be. And that is really what the model from the beginning of the video said. Until you see volatility rising in the tech sector, don't expect too much movement in anything, really. And that is what we're getting. So I would have thought some more sideways, testing possibly these levels around 15,000, 15,100. But I'm not holding my breath for any big movements here. Not until we see data, not until NFP, not until bonds start breaking things. And I think, I'm not going to keep on repeating myself, but the only thing that's going to break this is bonds. And really all the equity markets, including Europe, including Japan, are actually showing you the same thing. The 200-day moving average is still going up, and every time we come down, we get to support and it bounces up. I think it's going to take something like turning this average. It's going to take time. On the weeklies, and I think those are probably the most interesting, it's bouncing off support very nicely and going back towards, the resistance. And it keeps on hugging the descending moving average, the Bollinger Band rather, but these are not violent moves. And it never closes right at the low, which is the thing that I'm looking for to signal a little bit of acceleration. So there is no acceleration to the downside in European markets, and there's no acceleration to the downside in Japan. There's no acceleration in FTSE. Why would I expect acceleration to the downside in the US? Not unless bonds start breaking things, and they're not right now. Right, I think I've bored you enough. And as you probably gathered from this video, these are the only things that I care about. 10s and 30s. If they start breaking, I start changing my mind. But until and unless they start really breaking those levels, I have to expect them to trade in a range off of those levels in yield and come down 10, 20 basis points and trade the range. If that happens, everything else is going to be bid and trade the range. So there you have it. I think that triangulates it all the way I see it. But if bonds start breaking, then everything should break with it. Let's see what happens. Have a wonderful weekend and tweet you tomorrow.